5.5%, unchanged. It was basically expected, but it seems that the Reserve Bank governor could be leaving the door open to a possible rate cut. Is that your view as well?
That's my view, and it's interesting because currently what the bank is facing is an upward trend in inflation going forward, according to the bank's own forecast. And according to high-frequency data, we know that growth is going to get softer, even from the 1.3% we've seen in the second quarter of the year. So that's the dilemma that the MPC is facing, and that's why she's leaving the door open for an interest rate cut to support economic growth. And I think that's going to largely depend on what happens in the global economy.
What is that going to do to the savings rate here in South Africa if we do see another rate cut? Because perhaps it would be spurring growth, but some say it's only going to be benign, but it's going to have a bigger impact on savings in the country.
You know, the household sector in particular is not known for saving. The savings that we have as a nation comes from the corporate sector, and I don't think that's influenced largely by interest rate changes. What it can do for saving is that if interest rates are cut, your debt servicing cost is going to come lower. You might have a bit of disposable income to save. The household sector itself does not change. If you plot the rate of saving by the household sector against changes in interest rate, you'll see that it's not really influenced by interest rates. However, my view is that those who do depend on fixed income are going to be negatively impacted.
Absolutely, there's no incentive when you've got such a low interest rate to save at that point in time. Let's take a look at the global scenario and how much cognizance we should be paying to it. I find it quite interesting that the Reserve Bank governor was talking about the value of export traded out of South Africa into the rest of the continent is the same value that we're exporting to Europe, saying that we do have options down the line. Do you agree with this?
Well, I do agree with her. Interesting enough, yesterday, Nurel Robini also said that the only positive light, so to speak, at the end of the tunnel in the medium to long term is Africa and Asia. So if South Africa is more open to trade with the African continent, where growth is seen to be coming from rather than Europe, I think I agree with the Reserve Bank governor that that's where we're going to see the export market growing and benefiting from. Grow more trade into Africa, expand into the rest of Africa, and that's going to be beneficial to the export sector, not really Europe, because I don't think we're going to see a lot of growth coming forth from that part of the world for some time.
Do you think that the Reserve Bank governor should have actually cut this time around?
No, I was expecting interest rates to remain unchanged. Depending on what happens with the global economy, Eleni, I don't think the bank is going to cut. Was supposed to cut today. Going forth into the last meeting of the year, we'll have to see what happens in the global economy, because you don't want to cut too soon, and when you have to hike again, you have to correct it even more severely than you need to. So I think keeping rates unchanged is a safer option rather than cutting too soon.
With regards to the local currency and the impacts of this rate decision on the bond market, what kind of impact do you think we're going to have? It seems that it's largely been priced in, but the rand is really at the mercy of what we see globally. Well,
the rand has been changing so much this week that it's difficult to even tell what is going to be when we leave the interview. But what the impact of that on the MPC decision? I think that the MPC was cognizant of the fact that if you see the rand depreciating, although they do say it's going to be a short-term thing, if you see that depreciating, the danger is that you're going to have imported inflation going up. We already know that part of the inflation trend, what's going to push inflation higher are exogenous factors that are going to be imported. So if the rand depreciates, that is going to make that danger more acute, and so I think they bore that in mind today when they made the decision.
At what level should we see growth for the Reserve Bank to actually come in and intervene? Because we largely know where inflation is going to be going this year and next year, but growth is a big unknown because the second quarter number, as you alluded to, is dismal, 1.3%. At what level will the Reserve Bank stand up and be really worried?
I think when the MPC meets next quarter, it's not going to, we won't know at least yet what GDP is going to be, because I think it's going to be in the first part of November, and the GDP numbers are going to come out. What we do know is that the high frequency data will already tell us what more or less where the level of GDP is. We know already that manufacturing, the PMI, is trending down. We know mining output is not doing well. we do know that consumer spending is not going to go up if we don't see a meaningful change in disposable income via employment. So I think they're not going to wait and say, oh, GDP grew at 0.8%, therefore cut interest rate.
Yeah.
They have to be forward-looking. So it's going to be the high-frequency data that determines that. It's also going to be what happens globally that determines that. We'll see what happens in the next few weeks.
Do you think now that the rand has weakened, and of course it's only been a week or so that we've seen this immense weakness, do you think the Reserve Bank should hit the brakes on reserve accumulation?
I don't think so. I think they're going to do, if they do it, they're going to do it prudently. However, as they say, they're not going to make their decision based just on what the rand does in a week, because this is mostly risk aversion, and they will take advantage of whatever is happening currently. But I think making long-term decisions, as you say, the rand has just depreciated for a week.
Tendani, looking at the Reserve Bank, well, the central banks on a global level, and the Fed in particular last night, talking about Operation Twist and focusing on the longer end of the curve and longer dated bonds. Do you think this is the right process to adopt, and how would that affect thinking here?
I think they have run out of options. There isn't a lot to do when your interest rates are that low, and this was supposed to reassure the market to say that they're going to push long-term rates lower and therefore encourage spending by businesses if they borrow and spend, and banks to lend to consumers and get them spending. However, I think that was, for me, that was overshadowed by the fact that they're not expecting the economy to really recover. And I don't think that has done enough to assure the markets, and hence we saw the reaction was not as positive as I thought Bernanke would have wanted.